Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am going to chat with Xiao Yuan, who is the managing director of Hageman Capital and manages the day-to-day operations as well as leading all bond structuring and negotiations for the Hageman Capital portfolio. So, of course, we don't understand what bond structuring is, and that is what Xiao will explain us as well. And he will explain us about how developers can maximize their real estate potential by involving the municipality or the local government by providing them some tax incentives. So welcome, Xiao.
Alpesh, thanks for having me. Appreciate you taking the time. Appreciate being on the podcast.
Oh, thank you. So we start with this question with everyone, right? Tell us something interesting or funny about yourself.
So my friends won't play Monopoly with me. This probably started when I was pretty young, and it has actually extended into adulthood. I'm the guy that's always making the backroom deals, during turns or in between turns. And a 2-hour Monopoly game typically drags on for 4 or 5 hours. And so I think folks that are really close friends of mine know better than to play Monopoly with me. And I'm not even particularly good. I think I just like to drag the game out, way longer than it really needs to be. So.
Wow, that's interesting. So let's talk about, because this is an investment show, so we always want to know what you are up to. So what kind of assets do you personally invest in and why?
Sure. We have some, I would say, commercial real estate or multifamily projects that my company invests in, but also individually will invest in as well. But outside of that, I really invest pretty heavily in just traditional equities as well. I think part of it is, I have this adage that you want to invest in things you understand. You want to invest in asset classes you understand. But if you're investing and there may be asset classes that you don't fully understand, I think it's just better approach to be more of a broad-based investor. I work in commercial real estate and kind of see commercial real estate on a day-to-day basis, especially multifamily. So typically projects that I'll invest in are multifamily projects. But at the same time, the equity side, just the traditional equities that I invest in, are more broad-based, right? So those are kind of my investing ethos. It's actually a lot of the ways that I view money is kind of in the same way as well. Really focus in and keen on things you understand, and put your money to work in those areas that you have a good grasp of.
Right. No, that totally makes sense. So we wanted to talk about this, and of course you have mentioned it as TIF, but what I referred them as municipal and local tax incentives. But what exactly are they?
Yeah, so tax increment financing, I would say it falls in sort of a broader umbrella of local municipal tax incentives. If you think about local municipal tax incentives, it falls into a couple of different forms, right? And really all of them are used in conjunction or can be used in conjunction with each other to help incentivize a project that the municipality wants. A common municipal incentive in the past has been abatements, in which a developer is not paying taxes on its project for X number of years.
And I heard that.
Yeah, absolutely. And then the other side of it is tax credits, which is a vehicle that is growing and really has a stabilized market in which a state government or local government gives you a tax credit, which is offset against taxes that you would have to pay otherwise. But what developers could do in those cases is sell those tax credits to folks that can actually use it. And
Oh,
that
that's
that can
interesting.
yeah. So that's kind of another form of municipal incentives. But really, this form of tax increment financing kind of falls within that umbrella, right? So what tax increment financing is the municipality is allowing a developer to capture the property taxes of a project that they're going to build. So this project may have not been built yet or is not built,
I see.
but what happens is if you have a piece of vacant ground, there's really not a lot of taxes generated from that vacant
Right.
ground.
Correct.
Once you put a 150 unit apartment complex, onto that vacant ground, those
Yep.
properties will generate taxes. And so what the municipality allows you to do is allows you to capture the delta between the taxes of the vacant ground and the taxes of the apartment buildings that you're going to build in the future. Securitize those that stream of cash flow, which is the taxes, for a number of years. And what a developer would do is then create a vehicle, which is whether it's a note or a bond that securitizes those future increments, and potentially find an investor to sell that increment to, which provides you that upfront capital, or they may keep it themselves, and it could be seen as a tax incentive or abatement, really, right? So that's kind of in a nutshell, really what tax increment financing is you're financing the increment of a sort of unimproved piece of land to a very improved apartment complex, and capturing those taxes and using that cash flow to finance a project.
I see. So we are referring TIF means tax incentive financing, right? In this
Tax increment financing. So the
tax
increment
financing. Okay.
Yeah. So the increment side of it is extremely important, given that if you're putting on, let's say, new windows on a already existing project, there's probably not a lot of increment generated. You can say, hey, I created some value, but not really, right? But really the increment that's I would say heavily generated is from unimproved property to improved property, right? So the assessed values of those properties, that delta is a lot bigger, and that's really what we're referring to tax increment financing, is capturing that delta.
Interesting. And again, I'm trying to wrap my head around this. It's definitely something new. What is Hageman Capital's role in this TIF space, though?
Yeah, so in the TIF space, Hageman Capital is a investor in really that securitized cash flow, right? So, what we do is we buy tax increment financing bonds or notes, and when we buy it, it's usually at the beginning of a project, where the project really hasn't started construction yet,
Right.
and so what developer would do is, sell us their bonds or their notes, and use the upfront capital that we provide to put into the project as equity, right? And the repayment source is from the taxes they would pay on their project every year.
Got it. So let me ask you a couple of questions about Hageman Capital's role then. One, what do you look for when you are trying to buy these bonds as an investor?
Yeah, so in the tax increment financing bond space, there's kind of two separate sets of tax increment financing bonds. So there's a set in which it's called a municipal backed tax increment financing bond, or municipal backed bond, where the municipality is really pledging its credit to the repayment of these these TIF bonds, right?
Okay.
And those bonds are usually very secure. They're rated. They're rated meaning there's a investment grade rating from a rating agency like Standard & Poor's or Moody's. And so those are the bonds where there's already a ton of liquidity in this space. Right. What Hageman Capital does is we buy the bonds that are specifically supported by the project of the developer. So no municipal support at all. And it's also kind of known as single site bonds or single site TIFs, in which the only repayment source of the bonds that Hageman Capital would purchase are from the property taxes of a single project.
I see.
And so, on one side you have sort of very secure, very safe municipal backed bonds. On the other side, you have really, non-investment grade, developer backed bonds, which is only supported by a single project.
Interesting. So what are some of the risks for you guys as an investor?
Yeah, so a lot of the risk kind of comes down to, not only are you underwriting, the health and wealth of an area,
Correct.
you're also writing the performance of the real estate.
Right.
You're also underwriting sort of what happens with assessed values in the future. You're underwriting construction risk, because we're providing capital up front to a developer prior to them starting construction. You're underwriting their equity stack. But then also, a lot of the risk kind of comes down to how do you ultimately structure the bonds, right? So what I always like to call it is, you're going to have folks that understand municipal finance, you're going to have folks that understand real estate, but you're trying to bridge those two sort of esoteric skill sets together in a way that you are underwriting a municipal product, but you have to understand real estate as well. So the risk really comes down to, not just, you're taking on some traditional real estate risk, but at the same time, you are underwriting a vehicle that is more of a, public finance vehicle, right? With taxes and assessed values and things like that. So that's really the risk for us. But ultimately, these products are, they're repaid by property taxes. So in that way, it's secure in the sense that, as long as assessed values stay at the level, where we projected, you're going to get paid based on the property taxes of the project. The risk really comes down to, if your projections are off, or, if the structure of the bonds aren't, sort of ironclad, you're taking risk as an investor.
Okay, so a couple other questions. I know we wanted to talk to the other side about the other side, developers and real estate side. Are you guys coming in as debt investors or equity investors?
We're really equity investors. We're not taking equity, and I'll sort of preface by saying we're not taking equity returns. So the returns that we're really, getting from the bond is just the cash flows from the taxes that the developer pays on the project.
Nice.
We're not getting, distributions from NOIs or anything like that. But what our capital is seen is it's treated like equity. It's just equity that you're raising a lot cheaper than traditional preferred equity, LP equity. So while we occupy a equity position, when a bank is looking at a transaction, we're not getting equity returns, right?
Okay.
And part of it is, we're not.
That's the reason I was asking the vendors.
Yeah, we're also not taking equity risk, because we are taxes, and typically taxes prime, the most of the capital stack. But
Right.
at the same time, it's not like we have ownership in the project. So it's just that the capital is treated like equity because it comes in before the debt.
Got it. And what kind of returns do you guys target?
That kind of depends on the project, the risk that we are taking. I would say typically, because we're first capital in, we're capital in before the bank, but we're also not taking equity returns. We like to target a rate of return between what a commercial mortgage, first mortgage would be, and what a pref return on on equity would be. So, and we think of it as that's kind of a thoughtful range because we're taking construction risk, but our capital is coming in first, but it doesn't have sort of the same risk as equity, right? So
Right.
for us, I think that's kind of a thoughtful range for us to be. Um, and at the same time, our capital is not subject to sort of these variable rates. Typically when we buy the bonds on day one, if the bonds are a 25-year amortization, our rate is locked for 25 years.
Okay.
So part of it is, we're taking on a fairly sizable interest rate risk over time. Especially as interest rates increase in the future, we are taking on that interest rate as well. And so some of it is, we can't retrade a TIF after it's sold or monetized. And so, we need to sort of price with that in mind as well.
Got it. So maybe you're looking at 5 to 8% return, 10% return, just
I would say, a pref return is, in the nines these days.
okay.
Commercial mortgages are probably in the sixes based on today's
Right.
environment. So I would say, I think depending on the project, really it's kind of between there, right?
And how long is your capital typically tied in the project? On average.
We're really one of the first money in, last money out.
Yeah.
So I would say in Indiana, the TIFs that we purchase have typically a 25-year
Wow.
maturity. So our capital may be tied in there for 25 years. And our structure is a little bit different in that Hageman Capital is really an extension of a family office. So our capital is a little bit longer looking than I would say traditional investors would be. And so our desire really isn't to sort of retrade or pivot or sell these really illiquid assets. But instead, I think kind of just hold on to it and make sure that our underwriting in the beginning of the project is really, really rock solid.
Oh, that's awesome. So yes, we spoke about investor side. Now let's talk about the actual real estate developer or the people who invest in the real estate. So why should real estate developers and investor care about TIF?
Yeah, so what a TIF does is it allows you to bring less equity into a transaction or potentially take less debt in a transaction because it's kind of seen it. You're going to pay taxes anyway, but instead of sort of paying taxes to a variable sort of taxing district, the municipality allows you to capture tax increment financing so that it juices your capital stack, right? So what TIF does is, it allows a project to occur where it otherwise may not have occurred, right? And so for a lot of economic development purposes, if you're building something that I would say is, looks really nice, real high class A apartment complexes with, sort of a mixed use component to it. Usually the pro formas on those deals are stressed for many reasons, right? So for, your land costs may be higher. You want to build something that is architecturally appealing, but there's cost to that, right? Sort of nice exteriors have additional costs that your class Bs just won't have, right? And so in order for you to want to build a project like that, there has to be some sort of a municipal incentive to it. Otherwise the returns won't work. Otherwise the deal's really not a bankable deal. And so, for developers, I think especially commercial developers that, are looking to sort of build these placemaking projects and work with the municipality, TIF is a really important component in a lot of deals that we see in the Midwest. It's really been a powerful tool that it's contributed a significant amount of capital to the capital stack. At the same time, really not taking away from the existing taxing districts because it's not an additional tax, right? It's just the tax you would have paid otherwise. Or, in many cases, right, if you've never built a project, there would have been no taxes on that parcel anyway. So TIF, I think for developers that are, I would say, community conscious, wanting to build something that is impactful, work with the municipality to create something that's going to be lasting, but also make sure, in their capital stack, have a project that is viable to investors. TIF is just a really important tool.
And so we spoke about as an investor, as a financer for the TIF, as you guys. Then we also spoke about real estate developer. How is TIF beneficial for municipalities?
Yeah, so what a municipality gets is it gets a project that may have otherwise never happened. It helps, if a municipality sort of takes a long run view of TIF and development, what it does is after the expiration date of the TIF, the additional sort of tax base that was created because of the TIF goes back to the municipality, right? So that's really how they're growing their tax base, and it really spurs new development, in their communities, right? So where we live in a northern suburb of Indianapolis, so Carmel, Indiana, I think has been masterful in using tax increment financing to spur significant growth in their community, in adding to their tax base, but at the same time, really having a commercial tax base pay for goods and services and infrastructure so that the residential tax base don't have to sort of absorb that burden. So it's one, it's really seen as an economic development tool, but two, it's a great way to grow your tax base over time.
Interesting. So now, I kind of understood there are a lot of things involved here, right? Can you tell me one thing, does this only work for real estate developers or if someone is trying to reposition the asset, would this work as well?
Yeah, so redevelopment, I would say depending on the state, a redevelopment project may make sense as well. But you really have to sort of redevelop an asset that I would say is blighted or needs significant conditioning.
I see.
And it's really not meant for, you take a very, class B plus retail building and wanting to convert it into, class B plus multifamily. That's not really the intended use of it. Really, tax increment financing it's called a but-for test. Really, what it means is, TIF is really only granted in cases in which the project would have never happened without the TIF, right? So, repositioning is I think it's a phrase that gets thrown around a lot, but really, I mean, from a TIF perspective, it's really the redevelopment of an asset that may be blighted or needs, significant reconditioning.
Got it. So mostly this would apply to a brand new construction development, unless you are doing significant redevelopment pretty much.
Yeah. So, if you're repurposing sort of former manufacturing plant that's vacant now, TIF can be used for that. But that's spot on. That's a very significant sort of haul, right? That's going to be a very different project from what the use was, prior to that.
Got it. Now, the one thing, so I want to understand how the entire mechanism works. So can you take us through an example on, let's say, a developer finds a land and then, figures out that this is what he or she wants to build. Then what happens?
Yeah. So, a good example would be, we had a project in Carmel, Indiana, which, again, very affluent suburb, northern suburb of Indianapolis. The developer wanted to build a 150 plus unit apartment complex, and, with a parking garage as well. And so, what a developer would typically do is, find the land, and really kind of create a plan of, what they want to put onto the real estate. And then sort of like most of your entitlement processes, this is really just another piece of the entitlement process. So, as you're going through zoning, as you're going through permitting and things like that, TIF kind of gets really thrown into that process as well. Because what this developer realized is that without TIF, they weren't going to be able to do the project. And so really throughout the entitlement process, they're negotiating with the municipality on what percentage of the future property taxes they're able to capture. They're negotiating on how long the TIF can be outstanding for, and really, they're negotiating on, just things as minute as what does the architectural design need to look at? How many parking spaces do you need to have? How many units do you need to sort of set aside for condominiums, which is not as heavily TIF incentivized as traditional multifamily. They're negotiating on how maybe something as minute as how big the square footage is of the building, right? So these are kind of all during sort of this permitting and entitlement process with the municipality. And so really when we come in is after that process has kind of been set and the developer has a good idea or a concept of what the project is going to be able to generate for the next, in this case, it's 25 years. We come in and sort of put a value on that cash flow. So prior to them closing their construction loan, what we would do is we would simultaneously close the bond transaction with their construction loan as well, right? So the process is their equity needs to be spent first. What most developers do is, they'll take down the land with cash, or sort of start a lot of the pre-development processes with cash. But then over time, we would come in, essentially close with the construction lender, but the expectation is we would fund the bonds prior to the construction lender funding their capital. And so I would say, on a really 10,000 foot overview, right? It's not really any different than kind of your traditional entitlement process, but it was sort of pretty early on, as a developer, you need to understand whether or not you need TIF in order for the project to work, right? Because there's definitely some strings attached, and rightfully so, right? I mean, you're getting a municipal incentive, you're getting tax incentives to really sort of make your project more commercially viable, and so a significant part of the process is just working with the municipality to make sure that you are building a project that or creating a project that is TIF eligible, right?
So now can you give us an example with numbers, right? How it would work for the developer, you guys, investors, and municipality?
Yeah, so I would say traditionally what's been happening is most municipalities have been TIF has really been about anywhere from 10 to 15% of the capital stack. So let's use a $50 million project, make it easy. The TIF equity would really come in at, let's say 10% of the full capital stack. So call it 5% of $5 million, on this $50 million project. What a developer is required to do then in their case is they need to bring an additional 10% equity to assume kind of like a 80% loan to cost sort of scenario, right? So the TIF investor, us, we would bring $5 million of the equity. The developer would bring a additional $5 million of equity, and the remaining 80% would be financed by the construction lender. So $40 million to be financed by the construction lender.
I see.
So that, I would say that's typically kind of how a TIF capital stack would look like. What you could do is you can also, sort of, there may be other potential capital stacks or sort of sources of equity that can come into the deal as well. So things like tax credits as well would sort of come in be more seen like equity as opposed to debt. And really sort of the remaining balance, maybe mezz loan and maybe, things like that can be seen as equity, but not equity, right? But really, right. You're trying to solve around what you can generate from the future taxes of the project. versus, how much equity you need to provide, right? So more sort of these outside equity sources can come in that I would say fairly low cost, the better it is for a development project.
Got it. Another question, because this topic is really interesting. So I'm throwing you a lot of questions. Um, does this provide any kind of tax benefits to developers or you as an investor, right? Because real estate, we also get depreciation benefits and whatnot. Is there any benefits for you guys or developers?
No, not really in the
Okay.
sense, right? Because what's actually happening is, you're getting an income stream, right? You're actually getting income as a developer in order to sort of get a TIF, right? And so what a lot of developers will do in order to sort of avoid some of the upfront tax issues, or sort of the what you don't want to do is, sort of show on your income, hey, I just received a $5 million TIF. What a lot of developers will do is sort of structure it as a forgivable loan. And again, I'm sort of going to put out the disclaimer there that I'm not a tax accountant or your advisor in this sense, but I think what a lot of developers will do is kind of figure out, how do we structure sort of some of these incentives as a forgivable loan. But on our side, right, as a TIF purchaser or investor, the bonds themselves are tax exempt like any other municipal bond.
All right.
There would be some obviously tax advantages there, but typically with TIF, there's usually some sort of a component of a private use or a private guarantee, and what that means is, the proceeds of the TIF was used for sort of a private benefit to the developer that the public is not realizing, or the developer may be required to sort of guarantee the repayment of the TIF. In those cases, the TIF bonds cannot be tax exempt, right? And so in that case, while there's some state and local tax advantages, overall there's not a lot of tax advantages. And so, our expectation is, we're not purchasing these bonds, for the tax advantages per se. We're purchasing these bonds because we think it's makes sense from a risk reward perspective for us.
And when do you start getting paid? Or let me put it another way: when does developer have to start getting paying the interest to you guys? Or
yeah, so typically interest starts accruing sort of on the closing date, right? But usually what happens in the beginning of the transaction is, like most real estate transactions, you're going to have some sort of interest reserve built into your bank loan. You're going to have an interest reserve built into your TIF as well. So while the TIF investor is really getting paid, semi-annually every 6 months, for the developer, you're not really making your first payment from taxes until, your project is assessed and, first taxes begin to occur. So, in a lot of states, they sort of operate on kind of this double arrear structure, in which, if you finish construction in 2022, they're going to assess it in 23, but your first taxes may not occur until 2024.
wow.
So that's kind of maybe a good way to think about it. Again, it's not as if the developer is making extra payments in a lot of cases. They're just paying the taxes that they would have to pay anyway.
Right.
So, you're not, it kind of, depending on the way that it's structured, you're not making additional payments. You're just paying your tax.
Got it. So basically, you are then waiting for a year or two before you start getting paid anything.
I would say maybe that's a good way to look at it. But again, kind of like a bank, right? You have interest reserve built in to sort of account for the fact that, you are getting paid interest. It's just coming from sort of an upfront source, right? It's a net or a deduction from the upfront capital that you would receive, as opposed to it's coming out of the developer's pocket. But really, the dollars that are coming out of the developer's pocket is once taxes are assessed.
Got it. And taking this kind of TIF, what are some of the risks for developers? or the investors who have invested in that particular real estate deal?
Yeah, so for the developers, I mean, the risk is, if you sign an agreement, which is what we consider is a taxpayer agreement, where the developer promises to pay a certain amount of taxes. The risk is if the tax value is lower than what the taxes you signed away is, you have to kind of make up that difference, right? But sort of on day one, I would say that risk is somewhat remote. Because when you submit your pro forma to a bank, the bank is going to ask you, what did you project for your taxes, right? And so this is really sort of an agreement saying, I'm going to pay the taxes that are projected on the day that I ask the bank for money, right? And I think for us, this is kind of the same thing. But ultimately, for a developer, I mean, the major risk is, if you don't pay your taxes, which, again, I mean, I would say, regardless if there's a TIF or not, this is always going to be a risk. If you don't take your taxes, someone's going to come and take your property, right? And I mean, I think that's something that I think folks inherently understand, but I think if you present it in a way in which you're presenting it in this way, they may not really think about it. It's kind of like if you don't pay the taxes on your house, even if you're up to date on your mortgage, you still really don't own your house, right? Somebody can still come and take away your house. And so that's just something to consider, is that, your risk is really, if you don't pay your taxes, right? It's kind of the same risk as if you had on any other asset. So you're not taking additional risk. You're sort of just promising on day one that, I'm going to make these tax payments, I'm going to make these TIF payments. And if I don't make these TIF payments, somebody may potentially come and take my property.
Got it. No, this was really interesting. I had a lot of fun understanding about this. So we'll switch the gear now, because I think this was really helpful for a lot of people. Are you ready for fire round?
I think I'm as ready as I can be.
Would you be changing any business or investment strategy because of inflation or recession?
I would say overall, it's just a good practice to be mindful of what the economic environment you're in. But for the tip side, I mean, we kind of created a thesis that was supposed to survive through recession and inflation and things like that, in which we're buying tips in states that we understand and asset classes that we understand, right? So I don't think that strategy changes because of inflation or because of a recession. But we sort of fully expect that maybe the activity, the sort of the overall real estate development activity may decline because of kind of these macroeconomic factors, right? So we just have to be mindful of that. But I think as of today, I mean, we don't have a concrete answer saying we have this keen strategy if interest rates go up 200 basis points, right? And that to us, I think is not realistic. Just because there's sort of a strategy that was already set aside prior to kind of a lot of these macroeconomic conditions coming to fruition, and so it's really kind of a non-answer, right? I mean, the answer is yes, but we're still going to invest in high quality asset classes. We're still going to invest in areas that make sense for us, and we're still going to buy TIF bonds associated with those projects.
Yeah, and I understand, because you are totally looking at really long-term view. When you're talking about 25 years, then you have a long-term view on the economy and real estate market. Favorite real estate or finance or any other related book? Maybe it's a tax incentive book.
Yeah, frankly, I mean, I don't read a ton of finance or business books. Just really never gotten into them. But I would say, things that I can just broad-based recommend to anybody is anything by Malcolm Gladwell. Big fan of David and Goliath. And I think, he does a great job sort of telling anecdotal stories that, in a way, shapes, really changes the way you think about the world. So, I think these are books that kind of help you as a leader make better decisions, kind of understand, take everything with a more macro view as opposed to sort of looking just directly in front of you. So been a big fan of Malcolm Gladwell, and I would say anything by Michael Lewis as well is really good.
Thank you. Any tool or website you recommend or you cannot live without?
We use CoStar a lot. I think a lot of, as real estate investors and developers, and for us on the TIF side as well, just having an understanding of the area, having an understanding of kind of what the assets around the community you're about to invest into, how they're doing. It's very powerful. This by no means this is not an ad for CoStar, but
Right.
I think it's been a really good tool. I'm sure a lot of your listeners use it. It's what we use as well.
Especially for you guys who are looking at a long-term view of that particular market and the developers, CoStar is one of the, I would say leading indicator, right, for everything you do. Any advice for beginner investors?
Yeah, I alluded to this earlier. It's really sort of invest in asset classes you understand. And so for us, we at Hageman Capital, really the Hageman Group has been investing in real estate, since 2013. We had a really strong track record in just traditional real estate investment. But then, my experience prior to Hageman was, I was in capital markets, specifically focusing on high yield municipal products and tax increment financing. And so, you sort of, we are really created Hageman Capital because we understand tax increment financing bonds. And so that's why, we wanted to invest in them. But, I would say, I think for a lot of folks that are looking to invest, there really is, stay in your lane, right? There are things that, I think each and every single one of us understands maybe inherently better than others. And so I think it's important to sort of find a way to leverage and monetize that knowledge and invest, using that knowledge, right? You're not going to see me go and invest in sort of startup tech companies because that's just not something we inherently understand. But, I think for investors to be successful, it's really sort of invest in, sectors and assets and industries that you really understand. But also, understand, nobody makes money overnight. Patient money is always, I think, going to be, is going to win out. And so, I think everything that we do, even at Hageman Capital, it's got this long-term approach in mind. It's understand that, you're not investing in for today. You're really investing for the future. And so having that mindset, understanding that, and sort of, sticking to the things that we know and understand, I think will serve us very well. And I think it'll serve any beginning investors that you may have as well.
It's awesome. How do you give back?
Yeah, so I'm very civically involved. I sit on the boards of a couple of local nonprofits. One of which is called Reach for Youth, in which we, provide mental health counseling services to at-risk teens and youth. And, I would say a lot of our client base is, at or below poverty level. And so when we don't turn people away for not being able to pay. And so I've been serving on that board for the last 4 years, something that I really enjoy. But also, I belong to a Penrod Society, which is we're all volunteer organization that, we every year we run one of Indiana's largest art fair. And given the fact that it's all volunteer, no support staff, we take the proceeds we generate from the art fair and distribute it and grant it to other nonprofits in Indianapolis. So, definitely some of the things that I would say I'm more proud of, just being involved in outside of what I do professionally. So yeah, that's kind of some examples of how I give it back.
Got it. How can my listeners reach out to you?
Yeah, always a good way to reach out is going on our website, HagemanCapital.com. If you want to learn more about what the family office is doing, HagemanGroup.com. Again, feel free to reach out to us on LinkedIn, Hageman Capital or Hageman.
Thank you so much, Xiao, for your time. I really appreciate it.
Alpesh, thank you so much. Love being on, and hopefully your listeners learned something today.
Absolutely.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!